Yeah, so y'all could definitely see the title, preparing for startup and smaller business capital raising. This is something that, most business owners I know, um, we don't even think about that, right? We don't even think about raising capital and how we can get our businesses funded. We just jump straight out the gate. Um, I'm a business owner, I'm an entrepreneur, and then once we get into it, we realize that it's a struggle, unless we got a hot commodity and we got sales just flying off the shelves. But as far as just building, I mean, just starting from the ground up, coming up with an idea and seeking funding, um, whether it's from venture capital, friends, family, or any of those things. That's just something that the average businessman does not do. We knuckle up and come up with the money and start our businesses and hope to grow them, right? We kind of start out in reverse of how a lot of other uh, people start out. So, what I'm gonna do is I'm just gonna attempt to lay some groundwork, talk about some of the key elements of, capital raising activities, et cetera, et cetera, et cetera. All right. All right. So, a very important consideration, right, for startups and other smaller businesses in the pursuit of capital to fund their ventures, right? It is paramount, you know, to a business's success to have the proper funding, to be in a position to take full advantage of capital raising opportunities. Startups and smaller businesses, they must proactively prepare themselves well in advance of seeking new funds, right? So, it's highly touted and recommended that you seek counsel, whether you have an in house lawyer or an external lawyer. Um, they could play a key role in helping to guide you through the process, right? But what I'm going to do is I'm going to try to provide you guys with an overview of certain key issues, okay? Um, that you should know and that you should address. All right. When your company is planning near term capital raising activities, all right, we're going to address a number of key considerations for legal, financial, and other decision makers of startups and smaller businesses as they prepare for a proposed initial public offering, which is also known as an IPO. All right, we will also identify issues relevant to companies seeking other forms of investor financing, right, including private placements or investment by private equity or venture capital investors. All right, this capital raising activities are a long term possibility. All right, so we will also address key considerations for companies not planning immediate capital raising. All right, so these type of companies, they nevertheless could take steps to position their business for longer term capital raising opportunities. So we're going to touch on that as well. And with that type of advanced planning, companies can really avoid situations in which time and other pressures of immediate financing need lead to suboptimal decisions. You want to be in a position to be able to make your best decisions possible. All right. So let's talk about corporate organizational issues. So, a growing company preparing to raise capital must consider some fundamental issues relating to its legal form, ownership, and governance, right? So, the company should assess if it should change its legal form. It should determine how its relationships and agreements with its founders and early investors may impact a planned or potential future capital raising event. must begin implementing a system of corporate governance that will make sense for the company after the planned capital raising, right? And if needed, make the company a more attractive investment prospect, right? Okay. So, decisions made for a company early in its existence, even if they are ideal at that time, can become less optimal as the company continues to grow and evolve. This change in needs is particularly relevant to the entity type or corporate form or the company. Let me check on a few things here after going over these notes. Let me see if this live stream is popping and if anybody watching. Let's see. Okay. And they say the captions are auto generated. Alright. I'm glad this live looking pretty good. Alright, let me get off of it. Okay. Alright, so let me continue. All right, so let's just start over here. So what we're gonna do is we're gonna reassess the entity form, right? So decisions made for a company early in its existence, even if they were ideal at that time, can become less than optimal as the company continues to grow and evolve. So this change in needs is particularly relevant to the entity type or corporate form of the company. A new business often begins operations as a limited liability company or an S corporation. These forms of organization provide early stage business owners with the advantage of both limited liability and the preferential tax treatment of a partnership or sole proprietorship, right? Which are pass through entities not subject to double taxation at both the entity and the individual level, like a conventional corporation is, right? So once a company is in the market for outside financing beyond friends, family, or simple bank loans, it often finds that investors are reluctant to invest in a business organized as an LLC or S Corp. Instead, investors are typically looking to invest in companies organized as C corporations, which is the standard for most companies. Okay, so if you watched any of my other videos, I've broke down the differences between the C corp, S corp, the LLC, etc. So that's just one of the major things of when um, preparing the company for startup capital. You have to really be certain because most people only invest in C corporations. I got a partner that I've been trying to tell it to for some years now, but that's neither here nor there. He say he got it, but again, you have to make sure that your company is being managed as a C corporation. All right. Now, if you're not a C corporation, um, what do you do? Do you start a new company? Do you change your entity type? Do you reorganize? What is it that you do? So, if a company decides to reorganize, it can accomplish this in several ways, right? And usually on a tax-free basis. Typically, the company, you know, a good recommendation that a good attorney will probably recommend. Typically the company creates a new Delaware C Corp or LLC, which then acquires the existing business operate assets and operations through either an asset purchase, a one-step merger, or a holding company structure, in which the newly formed Delaware company purchases all the equity in the existing entity and retains it as a subsidiary. Now, the owners of the original entity and any new equity investors in the business become stockholders in the new company. This third option, it typically triggers few troublesome provisions in the company's existing contracts with third parties, right? And if you listen to the broadcast, man, you'll be sure to grab a pen, take you some notes because I'm going to be dropping some really, really good gems. All right. Now, I'll do more on, the tax-free reorganizations of LLCs. Um, I'll do a video on that. On that, I'll do a video on that as well. All right. So before a company undertakes any type of reorganization, all right, you must carefully review all of the company's contracts, current contracts, including contracts with suppliers, customers, and lenders. Okay, these agreements might contain provisions requiring the company to obtain the consent of or issue a notice to the counterparty before reorganizing. Also, allowing the counterparty to terminate the contract if the company experiences a fundamental change, such as a reorganization. So, finding these types of provisions is important, um, you know, and definitely finding these type of provisions in important contracts is usually not a cause for alarm. Okay, in many cases, contract counterparties will have their concerns allayed and agree to any necessary contract amendments after a conversation in which the company explains why it's changing its legal form. All right, so typically it's not an issue. Typically it's not a problem, with those you have contracts with. All right, so let's talk about your relations with the founders and early investors. All right, so preferential rights for founders and early investors. A frequent stumbling block for businesses seeking new investors and provisions in shareholder partnership and similar agreements that protect the rights of early investors and founders at the expense of later investors. Okay, so these type of provisions include right of first refusal or rights of first offer, tag along or drag along rights, buyout provisions which set a predetermined price or formula for a sale of an interest in the company. And so, also preemptive rights and restrictions on transfers. And when we're talking about provisions, we're talking about provisions in your company agreements or in your company document. So let's say if you have an LLC, when you first set up your LLC, there are provisions in your LLC, in your bylaws, that dictate how your company will be managed. So these are the provisions that I'm mentioning here. All right. Let's see. All right. I do got me a viewer. What's up, people? I'm trying to figure it out and see. Be sure to get your pen. Be sure to take notes. Come back over the video because there's going to be a lot of important jewels in here. And we're just basically talking about preparing, companies for startup companies for raising capital, basically. Um, all right. So where was I? All right. So, another thing is when a company is currently contemplating a particular financing, right? You got to determine whether the proposed transaction will trigger any provisions of this kind. All right.